Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is Thursday. It is the 2nd of September. It's actually my youngest daughter's eighth birthday. It's Rachel's birthday. Happy birthday, Rachel. All right, let's get into it, and let's talk about the market. We're going to be opening up in a little over 2 hours, about 2 hours and 13 minutes. A lot of stuff on the plate. We had a lot of news yesterday, and we've got a lot of news today. The big report today is going to be the jobless claims and international trades and goods and services. The international trade and goods and services will let us know how much global inflation, supply bottlenecks, and low level of employees due to COVID is impacting international, and inflation is impacting international trades and goods and services. That comes out in about an hour and 12 minutes or so. And then we've got the jobless claims report. Just to give you an indication, I believe the expectation is like 370. Oh, it's already 350. All right. Honestly, the number has been very, very solid for last 3-4 months. So even if the number is slightly higher, if it's below 375, 380, it's okay. The only issue will be if it goes up to 450, 500. Anything below 400,000 will be acceptable. I'm not too worried about that. Let's talk about global economy. First of all, you got to keep your eye on the bond market. All of this data that you're seeing right now, it's not really impacting stocks directly. It's impacting stocks indirectly. It's impacting currencies and bonds more directly than stocks. And what you're seeing in the stock market is an aftershock of what you're seeing in the bond market. I want you guys to remember that. It's not stocks dictate bonds, it's bonds dictating stocks. And right now, the bonds just don't know what to do with themselves. My opinion is that bonds are going to break down simply because if we haven't had a catalyst to drive it higher right now, meaning interest rates going lower, and they're not, the odds are we're going to go lower, which means rates are going to go higher. Let me talk about global economy, and I'll spring back into the news. It'll kind of give you a three-dimensional picture of what we're talking about. So global stocks rose Thursday after a soft U.S. jobs fueled optimism. That's the ADP report that came out yesterday. This report is not as accurate because it doesn't take into account government employee, which is substantial. So I wouldn't really hold my breath and put a lot of weight into this report, especially lately with what we're seeing in the market. But that's the report they're talking about. The spread of COVID Delta variant and anti-disease measures have depressed hiring and consumer confidence. Yes, it has. Consumer confidence reflects 2/3 on our economy, folks. I just want you guys to remember that. But that has reassured some investors that the Fed and central banks will postpone winding down the $120 billion a month buying of bonds that they have. This is what I mean, where negative news can be looked positive and positive news can be looked upon negatively in terms of the bond market. U.S. employment data is out on Friday. A survey by payroll ADP processors found companies added jobs more slowly than expected in August. We've seen that before. It's a private report. A separate survey, now this is important, by the Institute of Supply Management, a trade group of purchasing managers, showed manufacturing employment declined. That's a problem. That is a problem. The ADP I'm not too worried about because we're going to get the real deal tomorrow. But this manufacturing, that's an issue. But the bond market didn't go anywhere. Labor Department data could help investors get a clearer picture of whether the Fed will decide at its September meeting on a timeline for winding down its $120 billion in month of bond purchases. Ah, man. And my thing is here. If look at all the stuff that's happened in the last since January, February, March, April, May, June, July, COVID, weaker data, more issues with China, and the bond market hasn't taken out this high. And the truth is, the only reason the bond market would take out this high is if the Fed told us they were going to inject more money into the bond market to keep rates low or continue the timeline, but they're not. And the odds of interest rates going lower right now is just ludicrous. It's very low. Therefore, I'm really curious to know what in the world is holding this bond market up, because the bond market anticipates everything we know or think ahead of time. Maybe the bond market's anticipating that COVID will be here a lot longer, or the economy will be negative for much, much longer than expected, because the numbers are not looking all that bad. They're not looking amazing, but they're not looking all that great. Let's continue with the report. I needed to kind of explain all of this. A separate survey that we already talked about that. Now, forecasts expect U.S. employers to have created 750,000 jobs in August and pushing unemployment to 5.2. That's the target. That's this report coming out tomorrow. That's what the target is. Let's see if the target on Econo is exactly the same as it is. Sometimes it's a little different, but I want you guys to see what the consensus is. Consensus has now changed from 750 here? Yeah, it's now 740, but the unemployment rate 5.2. Keep your eye on these two numbers. These two numbers are going to be very, very instrumental in whether bonds go up or down. Let's look at the futures to see how we're doing pre-opening. Futures are, well, this is a good example. See the Dow under 50, under 75, up or down, randomness. Anytime I see the Dow either up 50, 60, anything below 75 or down below 75, it's random morning action. Looking at the put to call ratio, as you can see here, we're right in our window between the 105 and the 70. Anytime we're inside this window, randomness, just random market action. And if you look at the SPY, oops, I don't know why I'm looking at soybeans. It must be really early. But if you look at SPY, you will see that we continue to make all-time highs while momentum levels are declining, just like here. Look at that, just like here. And that is not, look at that. We had it here, and now we're having it here either longer. And I don't think we're going to sustain these levels much longer. The markets are in trouble. Although the put-to-call ratio is not telling us that, if you look at each individual sectors, and we're going to do that right now, you will see financial looks like it's got a little bit of downside before coming back up. Energy, it's on the way down right now. This COVID variant and this closures of airport closures, cruise ships again, this Delta variant is not good for the energy sector. Energies are down. Utilities are rallying because markets are getting more defensive. Utilities rallying is not bullish for the overall stock market. Industrial is choppy, not really doing anything. Healthcare, I like healthcare. It looks like it can sustain. It looks like real estate did about a week ago, so I like healthcare. Technology, volatility is low, but I like tech. Business to business tech, not business to consumer tech. That's consumer discretionary. So IT, semiconductors, deep tech, not soft tech like Amazon or Apple. Real estate looks like it's about to top out for a little short term and come out. Volatility is increasing. Consumer staples, along with utilities, these are defensive sectors. The fact that utilities and consumer staples is rallying is not bullish for the stock market. Communication sector looks like it may be a little bit overdone. Consumer discretionary look like it could go higher, but I don't think so based on the data we're seeing. And basic materials is flat. Where's the real estate sector? Yeah, real estate looks toppy. Honestly, the only sector I really like right now is healthcare and technology. And question mark on consumer discretionary if it can outperform this level. If it can outperform the current level, we may see some upside in consumer discretionary. But my issue is, why is consumer discretionary, which is the most discretionary speculative sector, why is it moving higher at the same time that consumer staples and utilities are moving higher? That's a no soup for me. That's a fragmented market. And again, when we look at the average, you will see technology and discretionary. Notice they're coming closer together. I like that. I like the fact that they're coming closer together, but they're still too far apart, which means the markets are fragmented. But again, if consumer discretionary, XLY, let's keep an eye on this. We definitely have to keep our eye on the consumer discretionary, because if the consumer discretionary keeps up, it may be very positive for consumer stocks. So keep your eye on this level, keep your eye on the 185 level on XLY. Very, very important. If Friday we break out of that level, that could mean consumer discretionary can go back up. So consumer discretionary, healthcare, and tech. Everything else is kind of choppy right now. Now, with that, I've got 3 stocks that are pulling back right now that should give us a good sustainable growth ahead. And they're all pulling back. You don't want to do breakouts right now, not with the market, not with the broad market looking like this. Look at that. That's not a breakout market or like that. And I know you're saying, Roger, why are you showing us small caps and mid caps? Because if you look at the S&P and if you strip away all the market capitalization, look at what it looks like. It's barely gone up. I mean, barely gone up. I mean, look at this. 152, 156 in 3 months. That's not going up. That's a choppy market. And again, let me show you this. Even on the non-capitalized weighted SPY, it's still diverging. Overbought. We need to cool off. We really need to cool off. Now, in terms of stocks, I like Pfizer right now. I think we're going to come back to the 50-day line, and then we're going to rally again. So give it a little more time, but I like Pfizer if we pull back just a little bit more. I like Nike right now. I think it's pulled back to the 50-day line. RSI is over, kind of done. The fact that consumer discretionary is near the higher end of the range bodes very well for this stock. But I'd like to see consumer discretionary break out a little higher before going in. But I do like consumer. I am starting to like consumer discretionary. I like ascending triangles. And the fact that consumer discretionary is going up, I want to see it break above this range. So Pfizer looks really good, but needs a little bit more to the downside. Nike, I think, is ready, and Decker Outdoor is almost ready. Maybe just a hair more. But I like Pfizer, I like Nike, and I like DEC right now. Don't go for breakouts. Pullbacks are your best friend right now because markets are very choppy, and there's not a lot of liquidity. Now, before I let you go, I've got something really important and something that can really truly help you make some cash as we head back into the fall season. Every single day, right around 3:00 p.m. Eastern Time, a market anomaly, that's right, a market anomaly forces Wall Street to start bleeding cash, giving everyday traders just like you an opportunity to make consistent returns overnight. Not day trading. You're in before the market closes, you're out the next morning. You're in before the close, you're out the next morning. What could be simpler? This is a 3:00 burn window, as joy of the trade, 𝗧𝗴𝗀𝗍 calls it. Allows anyone, even you, to buy low and sell high just 18 hours later. In fact, Jeff has already used this strategy to back dozens of overnight winners for his readers. Folks, for his traders and his readers. And now he's getting ready to reveal exactly why these massive profit opportunities happen. And I want to make sure you guys get your first row seat to this event and how it can help you start taking advantage of them right away. Folks, let's review. 18 hours, you're in at 3 p.m. Eastern, you're out in the morning. So there's very intraday trading risk. But you're not day trading. And I'm going to tell you something. Do you know where the market makes most of its money? On overnight moves. Jeff has used the strategy successfully to bag dozens of overnight winners for his readers. And now he's ready to reveal exactly why these massive profit opportunities occur. And now anyone, even you, can take advantage of them right away, especially you. Click on the link below to start capitalizing on these 18-hour explosions right now. 𝗧𝗴𝗀𝗍, he's an ex-hedge fund guy. He knows his stuff. Click on the link below and learn about these 18-hour explosions. Make sure to like this video, subscribe to this channel if you're watching on YouTube, and be the first to be notified when I post my next video for you. Don't you want goodies like this? Stock tips, morning analysis, put the call ratio, all the good stuff? Follow the link below and join the channel. Bye, guys. Talk soon.